Well, first of all, many thanks for having me here. It's a pleasure to be talking in front of you. I'm very happy that Charlie Galomides here is the new director of the Program of Financial Studies. He's been doing a lot of new stuff, a lot of new initiatives. This is very exciting. I am a professor of corporate finance here in the business school, and I do research mainly on corporate finance and also on banking. Now, I come from Chile, from South America, so most of my research has an emphasis on emerging market countries. So, I would like to start today's talk giving a very broad overview of the main obstacles that firms operating in emerging market countries face. So this is a survey done by the World Bank. It's answered by thousands and thousands of different small and medium enterprises around the globe. And as you can see from this graph, the main obstacle that firms face, or at least that they say they face, has to do with taxes, either high taxes or uncertain taxes, changes in taxes regulation, so on and so forth. The second main obstacle has to do with financing, which is going to be the topic that I'm going to discuss today. Now, when you study corporate finance and optimal capital structure, as I'm sure you've done, you're implicitly assuming that firms can raise as much external finance as they want. And that's a pretty good assumption for large publicly traded corporations in a country like the United States, but it's not such a good assumption for small and medium enterprises operating in emerging markets. So these are companies that tend to be young, they don't have an established reputation, they're kind of opaque. So there's a lot of asymmetric information between the firms and the providers of external finance. A small firm in an emerging market cannot raise public equity, it cannot raise public debt, so it usually relies on bank debt in order to finance. And why is finance important? Well, the firm needs to finance its investment in working capital. Maybe it wants to expand, so it wants to buy an equipment or a new factory, it needs to finance that. Maybe it wants to acquire another company. So these are different activities in which financing is very important. And in many cases, firms in emerging markets cannot raise as much bank debt as they wish in order to undertake these activities. Now, why? This is another survey done by the World Bank. And the number one reason for obstacles in financing has to do with high interest rate. The cost of debt is just too high, which discourages borrowers. The second largest obstacle, which is going to be the topic that I'm going to talk about today, has to do with high collateral requirements. So in a perfect capital market, what the bank does is that it analyzes the firm's expected future cash flows, and if these are good, the bank is going to give a loan. But as I explained earlier, if there's not too much information between the bank and the firm, the bank might require collateral to lend to the firm. Why? Because in the event that the firm defaults, the bank at least has the security that it can recover the collateral. It's going to reduce its losses upon default. It's just like when you want to buy a house, you ask for a loan to a bank. The bank is going to take a security over the house. So if for some reason you default, then the bank has the right to recover, to repossess, to foreclose the property. Now, in this research project, I've been trying to understand what exactly types of assets do firms pledge as collateral. And in emerging markets, the vast majority of collateralized loans are collateralized by real estate assets, land and building. Only a small fraction of loans are collateralized by other types of assets, such as machinery, equipment, inventory, or accounts receivable. We can look at the same figure, but for the United States, and it's going to be pretty different. In the United States, the vast majority of collateral is not real estate. It's machinery, inventory, and accounts receivable. So in the United States, banks think that these type of assets, machinery, inventory, etc., are an excellent source of collateral. But in emerging markets, it's different. Banks are somewhat reluctant to accept those other types of assets as collateral. So let me sum up. It's a fact that banks in emerging market countries tend to over-rely on real estate collateral for business loans. That's a fact. Now, why is this a problem? Well, basically because the other type of assets, such as inventory or machinery, lose part of their debt capacity, their capacity of raising external finance. And this is a problem for firms that have troubles getting as much external finance as they want. Now the question I'm going to ask in this research project is, why are banks reluctant to accept non-real estate assets as collateral? What's driving this problem? And the conjecture of the paper has to do with collateral laws. Now the way it works is that according to the law, there's two types of assets. Immovable assets on the one hand, that's just real estate. And then movable assets on the other hand, which is all the rest, inventory, equipment, etc. And each country has one particular law, collateral law for movable assets, and another collateral law for immovable assets. Let me give you an example. In the United States, the collateral law for movable assets is governed by the Article 9 of the Uniform Commercial Code. Regarding real estate assets, well, different states have different real property laws. The problem is that many countries, many emerging market countries, have weak laws regarding movable assets, which makes it hard for banks to accept movable assets as collateral. What do I mean by weak? Let me give you a couple of examples. So many of these countries lack a good electronic registry to register security interest over movable assets. So imagine that I'm a loan officer of a bank, and Charlie's an entrepreneur. He comes to my office, he wants to ask for a loan, and he wants to offer a piece of equipment as collateral. Without a good, efficient collateral registry, it's very hard for me to know whether Charlie has pledged that same machine previously to another bank. Now I know Charlie, he's my co-author, my senior mentor, he would never do that. But not all people are like Charlie. So without a collateral registry, banks may be reluctant to accept, let's say, equipment as collateral. Let me give you another example. In many emerging market countries, the only way that a bank can recover collateral in the event of default is through the judicial system. The bank has to sue the company, take it to court, and as you can imagine, in many emerging markets, courts are very congested. The judicial system is inefficient, and as a result, this judicial procedure can take a long time. In the meantime, the equipment or the machine or the inventory is depreciating, it's losing value, or can simply disappear. In the United States, on the other hand, the law allows the bank to recover collateral upon default, bypassing the court, without having to go through the judicial system, as long as there's no breach of peace. What is breach of peace? There's a famous case in law in the United States. A bank gives a loan to a lady to purchase a car. This is a consumer loan, not a business loan. The lady, for some reason, defaults on the loan, so the bank has the right to recover the car. What does the bank do? It calls the repossession man, called the repo man. You don't want to mess with those guys, by the way. The guy comes, the repo man comes with a tow truck, goes to the house of this lady, and is going to tow the car away. The lady sees that the repo man is coming, and she gets inside the car and she locks her inside the car. Now it's Friday, it's late, it's raining, so the repossession man simply tows the car with the lady inside. She leaves her inside the compound for all the weekend. There's 5 Dobermans guarding the compound, so she cannot get out of the car until Monday morning. So that would be breach of peace. So that's not allowed. So how do we test this idea that weak collateral laws are restricting access to credit? Well, in this paper, which is joint work with Murilo Campello from Cornell University, what we do is we look at a group of countries that improved their collateral laws, that they reformed their legal rules regarding collateral, and we see what happens with these countries, with access to credit in these countries, after such reforms were implemented. So we work with a group of 10 Eastern European countries. We collected firm-level data from 1995 to 2005 for basically the universe of firms operating in these 10 countries. Some of the countries, like the Baltic states, reformed early on in our sample. Others, like Romania, reformed in the middle of our sample, and other countries yet, like Czech Republic or Ukraine, did not even reform during this sample period. So, for today, I'm just going to focus on one case study, which is the collateral reform in Romania. So this is a news article about the collateral reform in Romania, which was announced in 1999 and implemented in 2000. Does anybody here in the audience speak Romanian? No? Okay. Me neither. Okay, so that's one thing we share in common. Let's trust Google Translator. So, according to this article, the collateral reform was very important. It created a super modern electronic collateral registry, which makes it very easy for a bank to verify whether an asset has been previously pledged before or not. So Charlie comes to my office, I'm the loan officer in the previous example, and in less than 5 minutes, he gives me all this information, I log into my computer, and I can see whether that piece of equipment has been pledged before or not. That's good. The other thing that the reform did is that it allowed the bank to repossess the collateral if the firm defaults in an extrajudicial manner, bypassing the courts, directly with the firm as long as there's no breach of peace. So this plot shows the evolution of the number of security interest in filings in this new collateral registry, which was 0 by definition before the collateral registry was created, and after the registry was created, there's a sharp increase in the number of security interest filings, which is telling us that agents in Romania are actively using this new collateral registry. In the same plot, I show the evolution of a measure of financial depth in Romania. The way we define it is by calculating the ratio of corporate credit given by banks in Romania normalized to GDP. So prior to the collateral reform, corporate credit amounted to around 10% of Romania's GDP. After the collateral reform, there's a sharp increase. And by 2005, it has practically doubled. So in this paper, we argue that a key factor behind this increase in financial depth in Romania was this collateral reform implemented in 2000. Now what's the problem? The problem is that this is a transition economy, so there are other things happening at the same time. Other regulations being implemented, other laws, other reforms. So we want to make sure that this increase in access to credit is driven by an improvement in the collateral law, not in some other type of reforms that the country might have been implementing at the same time. How do we deal with this difficult problem? Well, we do the following hypothetical exercise. We think, look, the firms that have more movable assets in their balance sheet to begin with, more machinery, more equipment, etc., should benefit more from the reform than firms that do not have too many movable assets in their balance sheet. Because remember, what the reform allows is for firms to pledge those movable assets as collateral. So if the firm doesn't have too many movable assets to begin with, it shouldn't be affected as much by the reform. So this figure shows an index of the intensity in movable assets across different manufacturing sectors in Romania. So let me give you an example. Manufacturing of glass, metals, paper are all activities that are heavily intensive in machinery and equipment. So the firms that operate in those sectors are going to have a lot of new collateral in order to pledge after the collateral reform is implemented. So those are the group of firms that should be affected the most. We call them technically the treated firms. On the other hand, consider manufacturing of precious metals. That's an activity that's heavily intensive in real estate. Firms operating in those sectors do not have too many movable assets in their production process. And as a result, those firms should not be affected very much by this collateral law reform. That's why these groups, we call them the control group. So, let me first focus on the treated firms, the firms that operate with a lot of movable assets in their balance sheet. So what this graph tells us is that this shows the distribution of zero leverage firms before the reform by size. So I have divided the sample of Romanian firms into 10 buckets of size, 1 being the smallest, 10 being the largest, and in the vertical axis I have the fraction of firms within that size bucket that do not have leverage at all, that their capital structure is 100% financed with equity. So these are firms that basically do not have any access to credit. Before the collateral reform, around 80% of the firms operating in these size buckets did not have leverage at all. They were financed entirely with equity. After the collateral reform, we see that this number decreases from 80% to 60%. So after the collateral reform, there's a bunch of firms that have access to credit for the first time. We think this is a very important result, and we call it the democratization of credit. Credit becomes available to more agents in the economy. Now what about the large firms? From the graph, you can see that before and after the collateral reform, there's not really any change. And this is exactly what we have expected, because those large firms have more reputation, are more mature, have faced less asymmetric information, have more sources of external finance, and as a result, they shouldn't be affected as much as the smaller firms. Now, as a sanity check, we do the same analysis for the control group, the firms operating in sectors that do not have much movable assets to begin with. And we can see that before and after the collateral reform, the distribution of zero leverage basically doesn't change. So there's no action happening in these firms that do not have too much movable assets. All the action is happening in the firms that are very intensive in movable assets. Now, the last thing I want to show you is a very interesting link between this collateral law reform and the efficiency of the judicial system in Romania. So as I mentioned before, one of the key elements of the collateral reform was allowing banks to recover collateral without having to go to court. Now, when is the benefit of bypassing courts largest? Well, when the courts are the worst, when they're the most inefficient, the most congested. So we collected data on the efficiency of judicial districts within Romania. So Romania has more than 40 judets, which are the judicial districts. Think about them as counties. And each one has their own courts. So for each one of them, we calculated the backlog per judge, which is the number of pending cases, pending commercial cases by judge in that judicial district. And we divided, for simplicity, Romania into two groups. Those with judicial efficiency above and those below the national median. And we can see that there's a lot of variation in judicial efficiency across different counties within Romania. Some of them, the judicial system is very congested. In other counties, the judicial system is much less congested. We can even look into a more granular region, Transylvania. I'm sure you know this region. This is where Count Dracula comes from. And even within a narrowly defined region, there are some counties in which backlog per judge is very high, the court system is very congested, and others where the backlog per judge is very low. So what do? We redo our analysis separately, first for the firms that are located in these judicial districts with very inefficient courts. And we find that the effect of the movable collateral law reform on access to credit is huge for this subset of firms. Then we do the same analysis for the remaining firms, the ones that are located in the judicial districts that have more efficient courts, and we see a very small effect. So this is a nice result, because what it's telling us is that the ability of banks to recover collateral without having to go to court is somehow acting as a substitute for a weak judicial system, which is something that's very prevalent in emerging market countries. So let me conclude. So as I said before, there's a fact that banks in emerging markets tend to accept only real estate as collateral. They don't accept other sources of collateral to the same extent that in the United States, like inventory, accounts receivable. In the United States, firms can even pledge their patents to a bank in order to raise external financing. And this is problematic, because it's not that firms do not have these type of assets in their balance sheet. Obviously they do. But those assets, those movable assets, cannot raise external debt, which constrains their firms in their ability to raise external finance. The conjecture in this paper is that this has to do with weak movable collateral laws. And how do we test this conjecture? Well, we look at a sample of countries that improve their collateral laws, and we see what happens with access to credit after such reform. And what we find is that access to credit increases substantially after the reform, and in particular, there's this democratization of credit. Large fraction of firms get access to credit for the first time. Now, this has important policy implications. The World Bank right now has this active agenda pushing for countries to improve their secure transaction laws, to introduce these collateral registries. I've been talking with the World Bank people a lot. I've been blogging about this. You can see that's my face. And what's kind of nice is that with this type of research, which has value from an academic point of view, also has value from our more broader policy impact. Thank you so much.